You should all, when you say something, I don't care, you should say, I don't care about this. Which means that you care about something else. Or you can say, I don't care about it yet, which means I don't know whether you care about it later. Never say, I don't care. You say, I don't care about it right now.
But I say, if somebody don't care about it, you just keep silence.
No, but I need to know, so you have to do this. So, but silence can mean many things. Silence can mean you agree, silence can mean you don't agree, silence can mean I understand, silence can mean I don't understand, right? Silence can mean many things. Silence can mean I don't want to talk to you. Go away. Okay, let me start. Okay, so we were looking at the balance of payments, and we said the balance of payments is essentially taking all the transactions of Vietnamese residents with non-Vietnamese residents. Okay, remember we're talking about residents. If I live in Vietnam for 1 year, even though I have an Indian passport, I become a Vietnamese resident. So it does not matter what passport you hold, it's just a question of whether, so when I lived in Vietnam for 4 years, I become a Vietnamese resident for purposes of balance of payments. Okay? And it's a record of all the transactions that are taking place between residents of Vietnam and non-residents of Vietnam, and transactions are taking place on the current account and on the capital and financial account. There is foreign direct investment. There are other kinds of flows into Vietnam, debt flows, equity flows. There are flows going to the banking system, which are not showing up here, so they are here. And then finally, if there is a surplus on the foreign exchange market, after all of the transactions of the private sector and the government and the banks have been taken into account, if there is foreign exchange that's left, then that's picked up by the central bank of the country, in this case the State Bank of Vietnam, which adds to the international reserves of Vietnam. Okay? So that is basically the external sector, and let's one second. And then there is this. In the balance of payments, you will usually see a line, errors and omissions. So all of these transactions, right, should add up to 0. All these current account plus everything above here should add up to 0, because we've taken into account everything that came in, everything that went out, and whatever was left was with the central bank. So before this happens, there is a line which is called errors and omissions, which essentially says, I don't know. I made a mistake somewhere and my number is not adding up. And errors and omissions can be in imports, in exports, and in other different things in balance of payments. Some of these may be related to exchange rate issues, but usually errors and omissions is a line which says that we did not capture all the transactions. So the current account plus capital account plus change in international reserves should add up to 0, but it usually does not. Therefore, you have to add another line in there, which is the net errors and omissions. Okay, so the current account balance of a country is defined as X minus M plus factored incomes plus these transfers. Okay, and the X includes exports of goods and services, and imports includes goods and services. YF is net factor income from abroad, and TRF is what is called secondary income, or these are the remittances or the transfers from abroad. It can also include grants that are received by the government of the country. Okay, so if the Ministry of Finance receives a grant from Germany, but that is included here because it's just a transfer from one government to the other government. There is a relationship between the balance of payments and the demand side in the economy. Okay? If we define absorption as consumption and investment, then the current account balance is just gross national disposable income minus absorption, which means that the current account balance is equal to gross national disposable income minus C minus I, by definition. But gross national disposable income minus consumption is just savings. Right? Remember we said gross national disposable income can be used only for two things. Right? If I have income, I can only consume it or I can save it. So what is not consumed is saved. So by definition, the current account balance is the difference between savings and investment. This is a very interesting and important identity because it's linking what is happening in the national income accounts to what is happening in the external accounts of the economy. Right? So if an economy is saving more than it's investing, it means that this number will be positive, which means that if your savings are more than your investment, then you have a current account surplus. If your savings are less than your investment, you will have a negative current account balance, which means you have a current account deficit. Does Vietnam have a current account surplus or a current account deficit?
I think it's
Deficit. Remember in the IMF report that we saw, it says Vietnam has a large current account surplus, but it's not all. Vietnam has deficit and surpluses. It's just that in 2023 it was a very large surplus, and by and large Vietnam has. So in some years there's a surplus, in some years there's a deficit. Similarly, for the US. Does the US have current account deficits or current account surpluses? Deficits. US is a country that has a very low savings rate. Given its investment, it runs consistently current account deficits. China is a country in exactly the opposite situation. It has a high savings rate. Given its investment and a very high saving rate, it runs current account surpluses. And that's what the US complains about. That China is running current account surpluses. If it has current account surpluses, then it is accumulating a lot of international reserves. What are international reserves? US dollars. What does China do with all these US dollars that it earns extra? It invests in the US. Buys US government bonds or other things that can buy assets all over the world. And that is something that the US has a problem with. Okay, one little thing to keep in mind here. Remember that this savings is for the economy as a whole. So it's savings of the private sector and savings of the public sector. This investment is of the public sector and of the private sector. Let's do a little bit of a calculation here. So the current account balance is the savings of the economy minus the investment of the economy. But the savings of the economy can be of the private sector or of the government sector. Similarly, the investment can be of the private sector or it can be investment of the government. If I collect the terms for the private sector, then this becomes this is the private sector, if both of these numbers are negative, so the budget has a deficit, and the private sector also has a low savings rate compared to its investment, this number will be negative. So the reason why the country has a current account deficit in this case is because both the public sector and the private sector are not saving enough. You have public deficits and the private sector does not save enough. If both of these numbers are positive and this number will be positive, which means that there is a surplus on the government budget and the private sector also has enough savings to cover the investment that it makes. If this number is positive and this number is negative, what will happen here? Depends.
Depends, yeah.
If this number is negative and this number is positive, what will happen here?
Also depends.
Okay. So we think of a country running current account deficits either because both the public sector and the private sector are running deficits, or one is running a surplus and one is running a deficit, but the deficit of one is bigger than the surplus of the other. What is the situation in Vietnam? This is Vietnam's situation. You have a budget deficit, but the private sector saves a lot compared to its investment, and therefore this number is positive. What is the situation in the US? I don't know. You have to find out. And I'll tell you where to find out. I don't know. I don't know the answer. I think they have budget deficits for the private sector, very large saving rates. So I think it's this. The same as it. I think this is the situation with Singapore. I think the budget usually is balanced or it has a surplus, and the private sector is made to save a lot by the government. Okay. Let's now look at the public sector. Well, the public sector is a big definition which includes the government, central government, Hanoi. Hanoi is here. This used to be Benzon. This used to be Benkat, I think. But now you only have this, and you have everything is mixed up here. Right? You have central government and you have one more level of government. But also remember that this is the government side. This is, when you add all these things, this is the general government. But the public sector is a bigger definition. There are public corporations. There are financial public corporations. This can be a government-owned bank. Military banks, I think it's a government bank. Military bank. Maybe that's on the high level. What is agriculture bank? Ag bank, agricultural bank is a fully owned financial corporation, that's here. Non-financial public corporation, Vietnam Airlines. Right? Monetary public corporations, Central Bank, State Bank of Vietnam is here. Non-monetary financial public corporations could be the pension fund, deposit guarantee, right? It's a financial corporation. It's sort of not, the pension fund probably would, well, the pension fund would probably be here. I don't know what the example would be here. So the public sector is a much broader definition than the general government. And in the case of Vietnam, I think we basically have information pretty much only about the central government. There is not that much information that we have. It may be available somewhere, but the budgets of the local governments I haven't seen. So when we present the operations of the government, what kinds of things do we need to keep in mind? Well, what does the government do? It takes your money. It collects the VAT, so whenever you go and eat your lunch, on your lunch there is what you bought, and then there's a VAT. That VAT that the government collects from you is in your taxes. And the government also collects social contributions. In the case of the US, there's a social security system. And then there are other kinds of revenues. Corporate income tax is an example of another tax revenue. Your motorcycle, when you register it, you have to pay a fee. That is to be in revenues. So there are tax revenues, there are non-tax revenues. The property that you own sometimes has to pay a tax. That's in the exports and the imports. So when the imports come into the country, there is a customs duty.
Yeah, custom.
That has to be paid. That is in the taxes. So all of the collections of the government in terms of revenues and fees is on the revenue side. On the expenditure side, the government has to hire
Compensation.
employees. So it has to pay them salaries. The wages and salaries are here. Then there is, the government has to buy furniture, paper, computers, everything. That's in the goods. And it has to, let's say, have a contractor come and fix the toilet in the government office. It happens. Don't laugh. It's a service that the government has to purchase in the market. When they would call a plumber, fix the toilet in the government office. That has to be here, right? The government has to pay interest on all the debt that it has. That is
Subsidize.
an expense for the government. The government has to give some subsidies. Let's say somebody is very poor, or in the case of the US, there's unemployment. The government of Germany, the government has to pay, these are social benefits. These subsidies are things that the government might pay, might provide to people to reduce the cost of buying something. Okay? So for example, if somebody is very poor, then the government can provide a subsidy to them to be able to buy something or access a service. Right? So those are subsidies. There are other kinds of expenses. And then finally, the government has to make investment. When the government acquires a non-financial asset, that means the government has constructed a road or a bridge, right?
Yeah.
Or the government has constructed a hospital, it owns the building. That's a non-financial asset because it's not a monetary asset. This is the new way that the IMF, which sets the standard for collecting data under. So this is basically government investment, IG, that we're talking about there. It's written in a slightly fancy. So revenues minus expenditures is what? It's basically how much you are borrowing or you have a surplus. Once you have that borrowing, you have to borrow from somewhere. and the government has to, where can the government borrow from? The government can borrow either from the financial markets, so it can issue government debt. The government can borrow from the commercial banks. The government can borrow from the central bank. The central bank is willing to give them money. The government can borrow inside the country. The government can borrow outside the country. So there is internal borrowing, then there is external borrowing. In the case of Vietnam, there is something that happens. There might be revenue that's left over from the previous year. If you have some reserves from previous years, you can use that also. So there is brought forward revenues in the case of Vietnam, not the case of fiscal. But the basic idea is that the operations of the government have to be put together. What is the government doing? It's collecting revenue, it's spending, and whatever it does not collect in terms of revenues and its spending, it has to borrow. It can borrow inside, it can borrow outside. Inside it has different sources of borrowing. Outside also it could have different sources of borrowing. We have different measures of the fiscal balance. The primary balance is the overall balance plus the interest payments. So all of the deficit, excluding the interest payments, is the primary balance. The cyclically adjusted balance is what? Have you heard that? Something like this before? No? No. Look at this, what it says. The cyclically adjusted balance is adjusted for the effects of the business cycle. What does it mean to adjust for the effects of the business cycle? We know that the economy has a cycle. It sometimes goes up, it sometimes goes down, and it's above or below potential. So this is time. This is, let's say, output. We know that the economy is growing, so it's going up, but it doesn't grow smoothly, right? Sometimes it goes up, sometimes it comes down, sometimes. This is what happens to the economy. Which means that somewhere along the way, there is an idea of potential output. Right? So this is actual output. And this is potential output.
So the central bank adjusts to offset the rising.
To offset the effect of the business. That's exactly it. So what we're saying is that when the economy is here, it collects a certain amount of revenue, and it collects a certain and makes a certain amount of expenditure. When the economy is in a downturn or a recession, right, the actual amount of tax collection is less than what it would have been if the economy were at its full potential, right? Because if output is down, incomes are down, the revenue collected will be less than what is possible if the economy were doing better. Similarly, if the economy is here, the expenditures that the economy might be making are more than it might have to make if the economy were at full potential. Why? Because if the economy is in a downturn or a recession, it is possible that unemployment would be higher. For example, if unemployment is higher, the government has to pay more unemployment benefits. So the unemployment benefits or the expenditure of the government is more here than it would be if the economy were here and unemployment was low. So when you take the actual revenues, let's say this is the actual revenues, and you adjust them to, so let's say the actual revenues here are R. When you make the adjustment to say if output were higher, then the revenues would have been R star. If the economy is operating at this point of time, the government expenditures is, let's say, E. But if the economy were at full potential, operating in full steam, then the expenditures would be E star. So the actual deficit is equal to the expenditures minus revenue, what you spend minus what you collect in revenues. Okay. So that's your deficit or overall balance. Let's say overall balance or deficit is this. But the overall balance adjusted for the cycle will be what?
E star minus R star.
And the two can be different. The two can be different because E star can be different from E and R star. And this is an important difference or distinction because this is something that we'll start using when we start thinking about, is fiscal policy too loose or too tight? If we look at fiscal policy using these numbers, it will give us one idea of whether fiscal policy is too tight or too loose. If we use this, after we've corrected for the cycle, we might get a different idea of whether fiscal policy is too tight or too loose. And that's the reason why we have this definition and this concept of a overall deficit. Because if we look at the deficit here, right, it might be too high, and we might think that the economy, the fiscal policy is too loose. But the reason why the deficit is high here is because the economy is not doing so well. The fiscal deficit here might be small or there might be a surplus when the economy is booming. But the reason why the fiscal deficit is small or there is a surplus is because the economy is booming. It's not because anything that the government did. So we have to take that thing out. That is not the action of the government. This happens to be it's happening because the economy is doing well. We have to take that part out of our calculation of the deficit. And the way to take that part out is to say, what would be the case or what would happen if the economy were at full potential? And then we can compare those two numbers to say, is fiscal policy too loose or too tight? After taking out the impact of the cycle. Makes a little bit of sense? Good. Okay. Similarly, we have other concepts of the fiscal deficit, and the concept of the structural fiscal balance is basically, there are things that the government does only once. Right? There might be fiscal transactions. For example, the government sells a huge building. Tomorrow, if the office of the Pilsen district office is sold, that big office with the corridor, very nice building, if it's sold, that building cannot be sold again and again and again. It can be sold only once. The government will get a revenue. It will show up as a very large revenue because the building is very nice, it will sell a lot. So when we look at fiscal, and in that year, all of a sudden it will look like the budget deficit is small because the government got billions and billions of VND by selling that building. But we want to take those things out because they are one-time transactions. That's not going to happen again and again. So we want to separate the impact of assets on the. And then there are other things that you want to take out of the revenues and expenditures because they have nothing to do with the role that the government played. It just happens to be the case the government got lucky and that it may not get lucky again. Okay? Okay. So, this is an example, I'm not sure, I think this might be Hungary or something like that, dollar billions or maybe, where you can, where this is a calculation of the different measures of the deficit. This is what the headline deficit is. When you calculate the cyclical deficit or surplus or the cyclically adjusted balance, you get a different number. And when you calculate the structural deficit, you get a completely different number. So your judgment about what fiscal policy is doing could be very different depending upon whether you look at the red line or the blue line or the green line. Okay? Because in one case, this is interesting. These two measures are telling you that there is a budget deficit. This measure is telling you that there is a budget surplus. This means that fiscal policy is tight, there is a budget surplus. This maybe gives you the idea that fiscal policy is too loose. This is a large budget deficit, right? Here again, you're getting a different message. Here you're getting the same message in terms of whether it's a surplus or a deficit, but the size of the surplus is very, very different. Okay? And we calculate some of these things for Vietnam to see what kind of an answer we get in the case of Vietnam. Finally, in terms of the monetary sector, the fourth sector that is in our framework, that's the financial system. And in the financial system, we have the banking system. The operations of the banking system are recorded in what is called the monetary survey. The operations of the other financial institutions are recorded in the balance sheets of the other financial institutions. The monetary survey covers the central bank of the country, or the monetary authority of the country. In the case of Vietnam, that's the State Bank of Vietnam. And it covers the balance sheets of the deposit money banks, Vietcombank, Vietinbank, Sacom Bank, Bacra Bank, Yen Phong Bank. Right? These are all the banks. They are all here. The State Bank of Vietnam is here. And we will look at the orders. What is the information that's contained in the balance sheets of banks? How many sides does the balance sheet have? Very good. 2 sides. What are the sides called? Left side, right side. 2 sides. The balance sheet has 2 sides, left side, right side. And what do you have on the left side?
Assets.
Alright, sometimes you may put liabilities on the left hand side. Doesn't matter. Well, assets, okay. And what's on the other side? Liabilities. Okay. And the assets are bigger than the liabilities, or liabilities are bigger than the assets?
So balance.
It should be equal. That's why it's a balance sheet, it balances out.
Yeah.
Right? So if you take a balance sheet, then let's look at a simple balance sheet of a commercial bank. Right? Okay, What do you include in the assets of a bank? That
Ôi ơi, đúng rồi, cash. Phải có tiền chứ, đúng rồi. Cái trả lời đó,
go to the internet,
đúng rồi.
find the balance sheet of Vietcom Bank, and find out what they have in assets and what they have in liabilities. How's that? Loans, because the job of a bank is to make a loan, right? Or basically, it has to give credit to
Yeah,
the
credit.
private sector. Right? What other things does it have on the assets?
Except
It's a liability. It's the deposit at the bank is your asset, but it's a liability of the bank.
Now about the opposite direction.
Which opposite?
I mean, the bank give cash deposit to other bank.
Bank, if the bank gives a deposit to another bank, give me an example. Which bank would give a deposit to another bank?
For example, Vietcom Bank then gives some cash to the central bank.
Okay, if the Vietcom banks gives something to the central, why is the Vietcom bank giving something to the central bank? For what? Why?
For them to invest.
Invest in what?
I just know. I mean,
Uh,
it can come from the idea that that they send money a lot among of them.
if Vietcom bank gives cash to the State Bank of Vietnam because it is buying a security that is issued by the State Bank of Vietnam, that can happen. And that happens because the State Bank of Vietnam says, I want to take money out of the system, right? I want to tighten monetary policy, so I will issue a security, and that security is taken by Vietcom Bank. So that security that's held by the Vietcom Bank is an asset of the Vietcom Bank. Okay, okay, good. So banks also hold government securities or SPV securities. Right. Good. Okay, then banks have receivables, all kinds of other stuff. Right? And then they have deposits, that's a liability for them. Then what else? They have payables, probably something like that. Okay? Okay, now the loans that banks make, they can either make to the government or they can make it to the private sector, right? And the deposits that they have can be either government deposits or they can be private sector deposits. Okay? And then there are other assets and then there are other liabilities. But something that we forgot here is that banks also have foreign exchange. They hold dollars, right? So they have, that cash is there, but let's say they have foreign assets, and these are dollars, right? The deposits can be either in BND or they can be dollar deposits. So let's say the dollar deposits, we can call them foreign liabilities. These are in dollars, and let's say these are BND. Well, these can, yeah, so the private sector dollar deposits are here, the government, the dollar deposits are here, let's say everything else is BND. Okay. Simple balance sheet, we don't need to get too complicated. Okay. Look at this, if I take the foreign liabilities from here and bring them here, net them out, then I can take this from here and make it net foreign assets, assets minus liabilities. No problem, I can do that. Let's take the private sector credit and call it loans to the private sector, let's call it credit to the private sector. Okay. And remember, there is credit to the government from the banks, but there are government deposits also here. We can net them out. So we can say credit to government. And if we take out these deposits from here, we can net it out, I can call it net credit to government. Right? If I take these other liabilities from this side and take them out from here, then I have other assets minus liabilities. There are all these other things also, payables, receivables, I can include it all, assets minus liabilities, and I can get something called other items net. Okay. So I've taken the balance sheet of Vietcom Bank and converted it into an analytical balance sheet where I'm separating the transactions in foreign assets, I'm separating the transactions with the private sector, I'm separating the transactions with the government on one side, which are the assets of Vietcom Bank, and on the right hand side, I leave the deposits. And these can be VND deposits, they can also be foreign currency deposits. Okay? In addition, I can take all of these things here. I can call this net foreign assets, and I can call this net domestic assets, because these are all VND things. Right? And if I add the balance sheet, so this is, let's say, Vietcom Bank, Vietcom Bank, Bắc Á Bank, Nam Ha Bank, ICB, all the banks there, do that. And similarly for the SPV, I can create a balance sheet like this, where it has net foreign assets, net domestic assets, and here it has liabilities. What are the liabilities of the SPV? currency. The Vietnamese dong that you carry in your pocket is a liability of the SPV. The currency that you have, that I have in my pocket, is a liability of the SPV. Okay? So when I add these two things, right? What do I get? So I take the assets on this side, add them to the assets on this side, take the liabilities from this side, and add this to this side. When I add the SPV to this balance sheet, what do I need to do? I need to take the currency from here, I need to add it to the right hand side. And this is the NDA of the commercial banks. This is the NFA of the commercial banks. Right? So when I add the SPV on this side, then I have to add the NFA of the SPV to this side, and I have to add the NDA of the SPV to this side. And when I do that, I get something that looks like this.
Bank system.
Right? Currency in circulation, currency here, deposits at the commercial banks, deposits, NFA, which includes the NFA of the SPV, and includes the NFA of the commercial banks, the NDA of the commercial banks, and the NDA of the SPV is here. And under the NDA, I have net credit to government. It could be from the SPV or it could be from the commercial banks. I have credit to the private sector, mostly by the commercial banks. And then I have all of these other items, receivable, payables, building, blah, 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 blah. I just make it up. And currency and deposits is broad money. Okay. Currency in circulation is what is called narrow money. Currency plus deposits is what's called broad money. Notice that already we have a relationship between the amount of money circulating in the economy, which is on the right hand side, some of the foreign transactions of the country, because the foreign transactions are in dollars. The transactions that are in dollars must be somewhere in the external sector and the balance of payments. Okay. We also have something going on in terms of the fiscal deficit, because the net credit to government is what? It's the total amount of borrowing that the government has done from the banking system, net. Okay. If it's credit to the government, it means it's borrowing by the government. If the government is getting money from the banking system, borrowing of the government. So we have a relationship between the fiscal sector and the monetary sector. We have a relationship between the monetary sector and the external sector. The credit to the private sector is what? Is the money that the banks are giving to businesses to invest. So that already brings us into some kind of a relationship with the real sector of the economy. So the monetary sector has brought together in it many of the interrelationships that we see with the other sectors. Okay. So there are linkages between the different sectors. Okay. So we have the four sectors in the economy that we talked about: the real sector, the external sector, C plus I plus G plus X minus M, right? That's what's in the top left-hand box. This is the external balance of payments that I discussed with you. That is the fiscal sector that I discussed with you. And this is the monetary sector that I discussed with you. Okay? Yes? Yes, yes, yes. And yes. Okay. If the government is receiving transfers from Germany, it must show up in the BOP because it is a transaction between the Vietnamese government and a non-Vietnamese entity. But that number also has to show up in the government budget because it's something that the government, besides its revenues, is getting, which it can use to spend. Correct? If the government spends on wages, right? If it calls the plumber to fix the toilet, then the plumber has the money to spend, right? And that's a part of government consumption. But government consumption, if it shows up in the fiscal sector, it has to show up in the real sector also. It is the CG. Okay. If the government spends to build a road or a hospital, that has to show up as government capital spending.
Investment.
But that government capital spending has to show up in the national income accounts also as government investment. Yes, yes, yes. If the government borrows from the banking system, then it is financing its deficit. It has to show up in the fiscal sector. But if it's showing up in the fiscal sector, it has to show up on the balance sheet of the commercial bank also. Because the balance sheet just gave a loan to the government. Or the government borrowed from the SPV. If the government borrows from outside to finance its budget deficit, it has to show up in the government budget accounts, right? Because that's the financing of the budget, that's the blue line. But if it's financing of the budget, it is a transaction between the government and somebody outside in Europe who's buying a Vietnamese government bond in euros. So money is coming from outside into Vietnam. It has to show up in the external sector, in the capital account. The government can either borrow short term for 6 months, less than 1 year, or it can borrow long term, more than 1 year. If money comes into the commercial banks, if dollars are coming into the commercial banks, they have to show up on the balance sheet of the commercial banks. But because dollars have come in, because somebody sent money to the banking system, it has to show up in the external sector also. Okay. If there is an increase, if there is a surplus in the foreign exchange market, which is in the external sector, remember we said all the private sector and government transactions are taken care of, and we have one extra $100 in the foreign exchange market. Where will they go? Well, the SPV picks them up. If the SPV picks up these $100 in the foreign exchange market, they have to show up in the external sector, but then they have to also show up on the balance sheet of the SPV. The SPV has 100 additional dollars converted into VND, and that is to show up in the balance sheet of the. I will let you think about some of these additional things. Bottom line, basic idea, we converted, we were thinking about a way of looking at the economy in which we've divided the economy into these four sectors: the real sector, the external sector, the fiscal sector, and the monetary sector. And it's a useful way of thinking about what's happening in the economy, because not only are these sectors interesting and important in themselves, but they also have interrelationships amongst them which can help us to understand the economy. Clear? Okay. So that's the basic macroeconomic framework. What I will do now, let's take a quick 5-10 minute break, because I want to start the Excel spreadsheet. So rather than taking a break in about 10, wait, we can go for another half an hour. Yeah, right. Okay.
Good.